I asked you to look at this. I'm sure, um, time was tight between last class and this class. But as soon as you have a chance, please get into review 1. With what I teach you today, you should be able to complete review 1 this weekend. That would be my recommendation for you to complete review 1. Oops. So this data, so the formulas that you'll use for this data are found here, right? And this data, in fact, is ex ante data. It gives you the probabilities. It gives you a distribution of the variables. And I'm sorry. It gives you information on 2 stocks and the market returns. And then from there, you're going to calculate the covariance of the returns. So you're going to get the returns for each, the stock 1, stock 2, and the market returns. You're going to get the standard deviation of each and the market returns. Then you're going to do the covariance of the 2 stocks, the correlation, the covariance of first stock with the market, the correlation. So it's the same formulas, but just for, you're going to do it with the market returns for each stock and then jointly with the 2 securities, okay? So it's a lot of work, but it's worth it to practice using the formulas, applying the formulas for this type of data. All right. Also on the platform, I mentioned that actually I'll just use this one, the same material. At the top of the platform, I put the exam solutions. So take some time to look at that, and hopefully tonight I can post your grades. But the most important thing was to get the solutions solidified, or solve them and post them for you so you can have a look. You can see how you did before you get your grades. Okay, any questions? So I'm going to go back to the notes. We're going to start now in with the notes that are, I keep doing this. I want to show you the platform where I'm grabbing the data from. So in Unit 5, here are the 2 videos that we made. These are all the review of statistics notes. The videos are below for the review of statistics. And then what we're going to talk now about is using and applying the tool of statistics with financial data. All right. And these are the notes that we're going to talk about today. I got them here. Okay. You can get the one with 2 slides if you like to print them. And this is what I expect you to work on this weekend, review 1. And the solutions are here, but you should work on those. This one here, this document, is the same set of formulas that we used last week and the other class, but I've used financial notation for them. And I encouraged you last week not to be intimidated by these formulas. These are the same formulas that we used last class. It's just that I'm calling these returns for the market, return to the stock. And because I've changed it from X and Y, I have to just write my formulas a little different. Do I expect you to write these out? No, not necessarily. You just need to know how to apply the formulas that were given to you here. Okay. So these are the ones for ex post data that you can put on your formula sheet. These are the ones for ex ante data. And you just need to know how to apply them. And our application is going to be in the realm of finance. All right. So I'm going to go now to the lecture notes. You can pull them up or you can follow along. And hopefully I'll finish today. Emilio.
Yes, I have a doubt about something from the material. It's
Uh-huh.
about ex ante and ex post.
Uh-huh.
We use ex post when there is population data or the
When it's
how
given,
do I identify
yeah,
what is
when it's given with a probability, basically. When you're given states of the world and there's a P. That's how you know. There's no P here, you see, because each of these are equally likely and it's historical data. So this will be given to you as ex ante, as predictive data of a distribution of outcomes.
Thank you.
Stochastic. Okay. Thanks for the question. It came up in the last class too. So now you know if it has a P in it. All right. All right, so let's go to the notes. Okay, so our goal is to first talk about where these returns come from in any given period. With the objective, knowing where these come from and then using these returns to come up with an estimate of the discount rate for firms that issue stock. That's pretty much where we're headed. Okay. So we're going to come up with a technique to estimate the discount rate. The last 2 units, we focused on estimating cash flow projections, right? We came up with cash flow projections. We learned about how to analyze cash flow projections given a discount rate. Or if not given a discount rate, we learned how to calculate an IRR to determine if an investment was worth pursuing. In the first 2 units, we talked about valuation of assets. Okay. All of things that we did until now, I would give you the discount rate. We're going to spend unit 5 discussing how we estimate a discount rate. This is a first step where I'm teaching you how to calculate returns, and we're going to focus on risky assets of stock to do that. All right. And then we're going to talk about combining those in statistics to come up with an estimate of the appropriate risk-adjusted rate of return that we should be using in our valuation. All right, so our goal is to find I, essentially, but I'm going to call it R because I got to give it a different name. Not to confuse you, but to distinguish it. So we're going to begin with talking about holding a security. So you hold a stock. And what's your return in any given period T? So T for today or time T. So at any point T, what is your return for holding the stock? If it pays a dividend, you receive the dividend as a stockholder. It's for each share. And you also experience something else, or you benefit from something else. What is the something else? I just underlined there. What is it called? Somebody want to read that to me?
Change in market value.
Thank you, Yadiel. It's a change in market value. By just holding a security that the market perceives as more valuable, you will experience a return, a positive return. If the market value goes down, your dollar return will go down. So just holding a share, not necessarily selling it, but the fact that the market perceives it as changing will impact your dollar return. Remember, even though we talked about in Unit 4, if you have a property that you could use to conduct your operations of your building, of your firm, if you had a building or a space, even though you don't use it, even though it's vacant and underutilized, there's still a value, a market value to it. And the same thing for holding stock that you don't necessarily sell, but the potential is there. So that goes into your valuation, your dollar return. So to calculate the change in market value, you look at the price today and you subtract off the original price last period, or the price last period. Okay, so this is what you earn holding a security. Now we got to convert that into a percentage, right? Because we like percentages. They give us relative measures. Statistics is about averages and relative measures predominantly. So we want to convert that into a relative measure of a percentage return. So we do that by relating it back to its original market value. So we divide by the original market value, PT minus 1. So don't let these notations disturb you. They're just keeping track, right? So the return, percentage return at time t is calculated like this. Now I can split that up into the dividend divided by the original price and separate that from the change in market value divided by the original price. And I come up with what's called the dividend yield. So this is the dividend return relative to the original price, or the price last period. And this is known as this portion, which is the market value divided by the original price, or change in market value divided by the original price, is known as the capital gains yield. Now we separate those out because, well, this is common practice to be concerned about dividend yield. Some stock don't pay dividends, right? And all the investors experience is a change in market value. Both of these returns are taxed. So stockholders have to pay tax, and sometimes the dividend, tax rate on dividends is different from the tax rate on capital gains. So it's common to refer to them separately. There's this other calculation that you can make similar to when we would calculate returns, like interest rate conversions. We always do that -1 at the end because we want to see things relative to $1 invested. For each dollar invested, as I interpreted here, for each dollar invested, you're getting 30 cents on the dollar, right? So this is another way to separate this piece out and differentiate it from the initial dollar investment. But I'm going to predominantly use these formula here. So what I want to do is an exercise where you're going to calculate it for the first time. In one period, you're going to calculate the return. All right, so I'm going to take these formula over with me so you can reference them. So try this problem. Let's try it together. Let's see. Oh, this is crooked. Okay, suppose a stock had an initial price of $42 per share, paid a dividend of 84 cents per share, and had an ending price of $46.20. Find the total percentage return. In other words, use this whole thing, and then separate into the yield, dividend yield, and capital gains yield. Let's see. So what value is this $42?
PT minus 1.
Very good. It's the original price, right? Original initial price. So PT, so that's the last period. And then the dividend is this one. This is DT. And then the ending price is 46.20, which is PT. Right? So using that information, calculate the return. Use this one first.
I got 12%.
That's right. Everyone else? Okay, so you put so I'm not putting years or periods. I'm just leaving it as T. Okay, just keep it simple. Leave it as T, and it's mostly the T and the T minus 1 are there to differentiate between the past and the current. So RT is equal to 84 cents plus the change in market value, PT, minus PT minus 1, and divide by PT minus 1. And when you put it together, you get 0.12 or 12%. If you do these separately, the dividend yield is 0.84 divided by 42, which is 2%. And the capital gains yield is the other part. Or you can just take 12% minus 2% to get 10%, or make the calculation yourself. It's 46.2, or I'm going to copy it over. Okay, so you see here, the dividend, someone has to lower their mic. Whose mic? Sebastian, your mic was on. Okay, so most of the return is in terms of the capital gains yield. The dividend yield is small, and firms can decide on don't pay dividends sometimes or at all, and investors still stand by the firm that they've invested in because they realize their capital gains yield. In the anticipation that they actually sell it, they'll realize that return. Okay, so for the stock, from the perspective of stockholders, that's 12% would be the return estimated for that period. Any questions about the calculation? So in review 1, you'll have a chance to make those calculations. Okay, you get familiar with it. You can see you can do this kind of thing with this formula in Excel as well to calculate returns. If you get, what do you need? You need the prices and you need the dividends. You need historic data on prices and dividends, and you can estimate returns. And that information is available. You could get that information from something like Bloomberg or from Wharton Words. We have a subscription to that too at the university, but you have to get permission to get into the Wharton database. If you want, if you're interested in that, you can let me know. All right, so let's see what else I want to talk about is that you've seen this formula before. You've seen it in action. In fact, this is the formula here. And it is a general version of this formula that comes from this formula. What formula is this again? You remember this one? What is it called? We had a name for it.
That was a growing perpetuity, right?
Right, the growing perpetuity or perpetuity with growth. That's right. What were the assumptions of the perpetuity with growth? Or the criteria that I used?
That G and I were not equal.
Well, that is not exactly the assumption, but yeah, it can't be. But there were assumptions about how it comes about. We assume that dividends, there are dividends, right? But dividends grow at a constant rate. So cash flows grow at a constant rate, right? So and also that the first cash flow is one period from valuation. And we had a bunch of other things, but these are the key or the differentiating assumptions. So first cash flow, one period from valuation. So notice, how do I relate this formula to this formula? Well, if the first cash flow is one period from valuation, I'm going to call this C1. I'm going to refer to the and then this continues, like this is just for one period. The formula that I taught you today is just for each period, but this relationship is through time and it's infinite, right? So throughout time, this is the case. Oh, I guess that's an important one to add. Cash flows are infinite. Cash flows are infinite. So it goes on and on and on. And so that's the dividend here. This is the price. And then this whole part is summarized as G. So this capital gains yield, if it's believed that it's constant, so if we have information or we approximate it as constant through time forever, we're going to just call that G. This is a percentage change or a growth rate in spirit. If you've ever seen this before, in economics, often there's an estimate of percentage change, and it's calculated by taking the new value minus the old value divided by the old value. And you can do that for different economic variables to come up with indicators or estimates of percentage change. But we're going to summarize that as G because it's a constant rate forever. So if that's the case, this is C1, this is the original price, and this capital gains yield is G, then R is just simply the interest rate. So you would do this if you have the market information and then any sort of announcement by the firm about their prospective earnings or growth. You have a valuation in the market right now at the selling price, and you'd have information on the coming dividend next period to shareholders today. You could estimate the I, which is, again, that's what we're going to be doing in this unit. Okay, so in fact, this is our first model. I'm going to call this model 1. If you can make those kind of assumptions, you can estimate using what's called the dividend growth model. You can estimate the discount rate or the interest rate or the hurdle rate or the rate that you use as your required rate of return. So back to what I said earlier, this formula we learned today is the more general version. This that we learned in Unit 1 is the more specific with these assumptions in place. Questions? You're going to learn 2 other ways of estimating the rate. So I'll just call this model 1 or dividend growth model. All right. No questions? So I can continue. All right. So the second way of estimating the return is using some basic statistic calculations. Keep in mind that these are statistics for rates that change. So if I have, for instance, let me grab this again just to remind you. And we're going to focus on estimating returns for risky assets. I'm not going to teach you how to calculate an index like the S&P 500. It's very involved because you got to find the 500 securities and you got to weigh them and all that. So we're not going to work with that, but you can imagine how that's done. But we're going to focus on calculating the returns for an asset and for, well, you'll see what we do with this. Okay, so keeping that in mind, I'm going to give you a data set to use to practice making these calculations. Okay, so you might be interested in a single measure for the return, the required rate of return using historical data, which is really the title of this lecture. You might be interested in getting the holding period return that shows you the return over a period of T periods. So for every dollar invested, how much do you make after 5 periods or T periods? That's one measure. A second is you might want to know what you made on average per year because the market is volatile. Returns can go up, they can go down. Even if you look back at BCE's returns, the highest they are 30, the lowest they are half of that, 15%. So it goes up and down. But we want an idea of what on average we made. If we invested our money and left it there, what did we make on average? Now you use the holding period return to get that. Just for a moment, let's look at the holding period return. This should look familiar. I'm just multiplying accumulation factors together, and notice the returns change. It's not like what we did with interest rate conversions exactly, but it should feel familiar to you. But what's happening is the returns are changing over time. Once we have that calculation of the holding period return, we can add back the 1 and partition that period into one period of the total. So that's what I'm trying to say. Those T periods, you want to partition them into 1 to get a measure of the average per year over that time. So we're going to make that calculation. And in contrast, another measure of average return is just the simple arithmetic average. Add them up and divide by T. All right. So you're going to see in this next example that there's going to be a difference between the calculations of the average return. Which measure, if you've learned about this before, which is a better measure of a return? Which better represents the data, or it gives you a better idea of what to expect? Geometric average or arithmetic average? Have you ever seen the geometric average before? No? All right, so let's look at the exercise I have for you, and then I'll talk more about the difference between these. So let's look at this data. This is the data from historical data. I've taken 4 periods. These are the 4 years surrounding the global market financial crisis. And I mentioned before that the return on the stock market over time, if you look at all the data, is about 11% on average. So in 2007, the return estimated was a little lower than that, right? Half of that. And then it was the crisis, right? So in 2008, investors in that period, for every dollar invested, lost 37 cents. It recovered, there was a correction, but did it recover completely? That's my question to you. Over this period, what are the holding period return? Get me a measure of the average in terms of geometric average and the arithmetic average. So let me grab those formula here so you can do that. I'll give you a moment to try that, and then I'll come in and see if I can help. Try to get this. I think it's better if I make it small. So you need to take 1 plus the decimal version of each of these, multiply them, and subtract 1. So I'm going to do it with you. Then what you want to do is put into memory each of these 1.0549, store 1. Now the second one you have to, it's 1 plus negative 37%. So you make a calculation of 1 minus 0.37 and store that in 2. And 1 minus 0.2646 and store that in 3. Sorry, not 1 minus, 1 plus, sorry. 1 plus 1.2646, I got carried away. Store in 3. And then 1.1506 and store in 4. Because I'm doing this. Then I multiply those factors and subtract 1. So recall 1 times recall 2 times recall 3 times recall 4 and minus 1. What does it say? What does it tell me? How do you conclude?
It lost on average like 3 cents.
It's not an
For all
average
those
yet.
groups.
It's not an average.
Not an average, not an average. That's the rate. The rate
That's
was a negative 0.03.
right. So my question was, did the market recover from the shock? And the answer is not fully, right? Not fully. Well, it didn't even break 0. And anyone invested from 2007 till 2010 did not realize a return. They realized a loss. So for every dollar invested in 2007, by 2010, they had lost 3 cents. So if you say recovered to have no losses, no, they had a loss. If you mean recovered to return to like 5 or 6%, it didn't even make it. Okay. So that's that calculation there that I just made. So the answer is no, right? The market didn't recover. Okay, so now we want to measure of the average, like Yaria mentioned, we want to measure of the average. So what we're going to do is, since we already have this calculation, we're going to use it. We're going to add back 1 and take the 4th root of that. So we're partitioning into 4, which are the number of periods that we've included, and subtract off the 1 for that initial investment, or that, sorry, for that $1 per, because we want to do this per dollar, right? So when we do that, be careful, it's always this minus that it's going to mess you up. 1 minus 0.0330 equals, and then put it to the 4th power, or the 4th root. So let me show you how you do that. It's just as important to make these calculations as to interpret them, all right? So I'm going to take that measure. Notice that on my calculator, I have I haven't rounded the number. So if I use that number on the screen, I'm going to get a slightly different value, but let's erase that and use the number in my notes. So 1 minus 0.033 equals, now I'm going to raise it to the power of 4 and I'm going to invert 4. And then I'm going to minus 1. That's how I get that. So try that. Make sure you can get that number. Everybody okay with that? All right, so what we found out is that there's a loss every year. Okay, that's important. So that's 84%, 0.84, sorry, percent, which is about 1% loss. And that makes sense, right? If it's 3.3 total, then it's about 1% a year. And that's estimated nicely with the GAR. Any questions about that calculation? So for every dollar invested each year, there was a loss of about a cent.
That negative 3.3 is throughout all the years, and the 0.84% is like the average per year, right?
Exactly, exactly. Now, this is how you calculate averages for rates, okay? And it's a better measure. It's a better measure than the arithmetic average. If you were to take the arithmetic average, remember just adding them up and dividing by 4, what we talked about with the statistics review. You can get this out of your calculator using stat mode or just adding them and dividing by 4. You get 2.5%. Which one do you think is a better measure of the average return over the 4-year period? They're different. So you have to pick one or the other because they're significantly different. For rates and when data are like volatile like they were, it's better to use GAR. So if these are different, So in general, use GAR. Okay, that's going to better reflect the return. Now, one reason is because we're using rates, and this is better because remember we talk about returns or compounding effect, right? So we need to use these factors, these accumulation factors, as a better estimate of that effect. Another is that the average return or the average is not a great measure of expected value when the data are not symmetric or balanced, or where there's extreme numbers or relatively extreme figures. Okay, so that's another reason. So when they're different, use GAR. Any questions? The only thing that's going to trip you up is this one here, the negative. Just be careful. You'll see in review 1, there's problems like that. You can practice as well. Okay.
Teacher, I have a question, but like it's more like if GAR is better at giving like results, why do we use the arithmetic average return?
Okay, because well, we learned all about the average, and I'm gonna explain that in a bit, just a bit. Give me a 10 minutes. Okay, good question. All right, so we've got a measure of return. We learned about, so let me go back and just recap. So we learned about how we can use the growing perpetuity formula and its assumptions to estimate the required rate of return. We call that model 1 or the dividend growth model. What I'm doing right now is pretty much like model 2, right? Just finding returns using statistics of historical data, if I have the historical data. So this is like method 2. I guess I'll put a title on it. So this is method 2. Just looking at returns, just working with returns to come up with estimates, historical returns. And it's not just about getting an average measure. Because the data, that doesn't really, just looking at the average or the expected value doesn't really explain the data very well. Here we have data over 80 years. I went a little beyond the financial crisis to 2016 and as far back as before the Great Depression. And you can see the more volatile, the more wild corresponds to the risky asset class as measured by the S&P 500 stock. That's the best performing stocks. So it's quite wild. There are extreme dips. This is the Great Depression. This was the collapse of the markets in the 30s, and it recovered and stayed positive until it dipped again. So it has wild lows and it also has extreme highs, and that's why it's risky and also why people are optimistic looking for those high returns. Less risky are the treasury bills. The treasury bills are backed with a guarantee. Remember, we talked about bonds and how bonds work. And in the agreement or certificate or indenture, there's a promise of the government, in this case, to pay the face value of the bond when it matures and possibly coupons throughout the term. So let's see, the bolder dashed line are T-bills and the less bold are 10-year, you'll see that there's more volatility, more change, and these are averages, right? These are these are measures that are for the 10-year much more volatile than for the T-bill that's a little flatter. Always positive, it doesn't dip down below zero very often over time. Okay, so which is the most volatile asset class among the three?
It's 500.
Say it again?
The S&P.
The S&P, risky securities, right? So stocks are more volatile, and this is a measure of the performance of the top performing ones.
I have a quick question.
Yeah.
You said that very rarely the 10-year T-bond is going negative. When it goes below the 3-month, that is called an inverted yield curve, right? Like
When
the
it
rate is below the 3-month.
well, it doesn't even look on here that it's gone negative at all.
You see those special occasions, I think.
Yeah, it doesn't dip down. We didn't have negative interest rates.
No, but below the 3-month. The 3-month.
Yeah, that's what I'm looking at, the bolder one. The other one, the T-bill, the 10-year bond is the one that's dipping down.
Yeah, when the 10-year is below the 3-month, it is when it is called the inverted yield curve or not?
No,
I'm just asking.
inverted yield curve is looking prospectively as opposed to this is historic,
Okay.
but they are connected. But this is looking historically at the returns. Now, returns for T-bills would be the right, that would be the yield, right? Yield to maturity of the T-bill that in secondary markets is determined by what it's selling for. Anyway, we're not going to spend too much time talking about bonds on this slide because I need to get back to stocks, but I wanted to just show that volatility needs to be considered. I can't just parade around the average return as a geometric average and say that represents the data set. We need to talk about the volatility. That was the main point of this slide. So let's get it. So what's the measure of volatility that we learned in statistics in our review, in our discussion? What's the measure of uncertainty, variability of variables or a return? What's the measure? What's the statistic?
Beta.
The slope.
Well, for this, just for if we just look at the data set, we want to talk about just the variability of the returns, not about beta is a different kind of risk or measure of volatility, but it's not this. I'm talking about this wildness here. How do I measure that? Somebody said it, I think. No, not the beta. I taught you about the beta because that's going to be at the end, but I kind of gave you a preview of where we're headed. But we're just going to calculate the variance and the standard deviation of returns. Okay, so this is the variance. We learned how to do that. I've just put it with R's in the formula, but it's basically, that this is the average squared deviation from the mean for historical data. And then I take the square root. So we can do that manually. I put it manually here. Why don't you use your calculators to get it? So we have some practice using our calculator to get it. We'll do that together. I will pull back. Let me get the data set. Oh, I got to do this again. The data set is here. So entering this data into your calculator rather than doing it the long way, but you should be able to do both. You shouldn't feel shy to do it manually or with your calculator. So using our calculator, remember for one variable, we have to go into data mode, clear the worksheet, and then begin entering the returns here as decimals. 0.0549, enter down, and skip over y because we just have one variable. So we have to do the subtraction. 1 minus 0.37 equals, what am I doing? No, I'm just going to 0.37 negative, sorry. And enter down. What happened? 0.37. I lost my data sheet. Okay, so that's the first one. Skip it. And then here it's 0.37 negative. That's how you deal with the negative. Enter down. Skip over y. Then 0.2646. Enter. Skip over y. And 0.1506. Enter. And that's it. And now we're going to ask for the statistics second stat and scroll through. Remember the average was 2.5 that we saw earlier. And the standard deviation is how much? What is that? Exactly.
69%.
It's 20, it's
Yeah.
almost 28%, the standard deviation. Remember, we use S. We don't use this one. Okay, this is for if the data is at a population level. This is not a population data set. This is a sample. And it's a sample. When it comes to returns, you could calculate returns over different periods. We've chose to use years as opposed to 48 months, as opposed to hundreds and hundreds of days or seconds. But anyway, so there's different ways to get your financial data. We did it by years. This is just a sample of 4 years. All right, so it's 27. Is that a high number for variance or standard deviation? Sorry. Notice it gives you the standard deviation, right? Which is the square root of the variance. Doing these steps, you will get the variance, and then you have to take the square root. Okay, so back to my question. Is this a high variance? Or standard deviation, sorry, is that a high standard deviation?
Yeah, that's very high.
It's very high, right? Seems very high. We have 10 minutes. Okay, so what do you do with a mean and standard deviation? If I have the mean, remember, was R bar equals 2.5%. And if you had the time and you needed to, you went through my stats review, I explained all this, but you should know all this already. What do I do with a mean and a standard deviation? How do I interpret that? What do I do with it? So what you're supposed to do with a mean and standard deviation is you say that if you believe you have symmetric data, or let's say we assume data are roughly assuming data are normal.
Calculate. Sorry.
Sorry, go ahead.
No, if the data is normally distributed, you can find the probability range.
Excellent, excellent. So exactly. So this is not a good assumption for 4 items, like for a data set with 4 observations, okay? But if we were to do that, and I'm going to show you when we can in a minute, answering Yariel's question about why. So or when. Why we learn about this. So if we assume the data are normally distributed, what we would say is that we would treat R bar like the mean, and you would treat the standard deviation as the true standard deviation, true standard deviation sigma, and you would calculate that between 2.5% and 27.69%. I'm just going to say, just to make this easier, 27.7%. In that range, we find how much of the data if we assume normality. So the rule is if the data are assumed normal or roughly normal, then
Intervals, don't we?
most of the data, normal means most of the data is around the mean. How much is most, to be more specific? Do you remember?
67%.
Close, yes, 68%. Okay, so
Yeah.
68%. So within 1 standard deviation of the mean, you will find 68% of observations. All right. So what is that? What are the limits there? Can you do the math and tell me? 2.5 minus 27.7. What is that?
Negative 25.2.
Negative 25.2.
Positive 30.2%.
Wow, how wild is that, right? So you could get, there's a 68% chance, or there's 68% of the possibilities are within the range of negative 25 and positive 30. It's very wild, very volatile, and some people will, risk taking, they'll shoot and try to get this 30% return within 1 standard deviation at the risk of losing 25% of their investment. So this is how we interpret further. Let's do the next one because we have a little bit of time. So then 2.5% plus or minus 2 times 27.7%. What's the chance of being within 2 standard deviations of the mean?
95.
Excellent, 95% chance. So this is really a lot of data, right? So you can figure out this is going to be very, very negative. You're in the 50s. I'm not going to make the calculation to spare time, but you're going to do that in this unit. And what about 3 standard deviations? What percentage of observations are within 3 standard deviations of the mean? Almost all of it, but not all of it. 99.7%. So what does this mean? The fact that a normal distribution covers 99.7% within 1 standard deviation of the mean means that 3% of extreme values are outliers. Extreme values on this data set. Now that's if you assume normality. We should not assume normality for this period for the S&P 500, however. Okay, it's not normally distributed. In general, historic data of the S&P 500 is roughly normally distributed, and I can show you that. I demonstrate that in the next few slides. Let me skip over this for a minute. So here you see the well, I'm going to go to this one. So here you see this is the last slide. You see the S&P 500. Now this is not perfectly normal by any means, but it's roughly normally distributed and it's above zero. You have a peak around here, and this is what I'm talking about. When you have roughly normally distributed data, the mean is a good measure of the center. Most of the values are around the mean. We're say approximately, 68%. And then there is a standard deviation. It's quite high. It's not 27%, but it's 20% on average. And that's compared to government bonds over the same period, this 80-year period. They are performing a little bit above zero on average. This is also roughly symmetric. So we use the mean and the standard deviation to talk about them. So these are government bonds that are not T-bills. T-bills, 3-month T-bills on average are 3.5% with a standard deviation of 3.1, although this is more skewed data. And probably a better measure would be the median, but we're not going to get into that too much. So essentially, in this class, we are going to work with the assumption that in a diversified portfolio of stock as represented by the S&P 500, we are going to assume normal distribution, okay? So having said that, what I want you to do is take the data, so the 11.4 and 19.7 I take from, I took it from here, okay? So 11.4 and 19.7, I want you to answer these questions for next week, work on review 1 as well, and we'll pick up from here. I want you to answer the question using the technique we discussed. What is the chance of positive returns approximately if you were to graph this as a normal distribution for the S&P 500? And then what is the chance that a return will be less than negative 30%? Okay, so I'll leave you with that and wish you a happy weekend. Do your homework, come prepared to class, and we'll have a good conversation. We're going to finish these notes for sure and start capital asset pricing model next class. And my goal is to finish Unit 5 next week. When I get back, we're going to just do some review. Lots of review. There's a lot of documents in this unit. Questions?
Quick question.
Yes.
Is next class online too?
Yeah, next week I'm going to be away as well, but I'm coming back after that. Yeah.
Okay.
Just one more week, and then we'll be together. And you will appreciate me, right? When I come back. I know this is not easy, but it's better than nothing. I think meeting together is better than nothing. All right, so we'll see you soon. Study, study. Let me know where you get stuck. Keep in touch. Okay, have a good weekend. Bye.
Have a good day, Professor.